If you've been investing money in the equity market, you would have heard this a number of times that the simplest way to make money as a fundamental equity investor is to research a stock well and buy it at a good value. And once you find such a stock, you sit on it for many years. Well, this strategy works well for the equity stocks but does not work well for your debt part of your portfolio. To learn how to manage your debt portfolio well, if you're a passive investor, do listen on till the end. Hi, my name is Harshvardhan Dawar and I'm the founder director of Wealth Café, where we help you make smart money decisions. If you look at the equity charts, you will find that the prices of the equity stocks, they move wildly, spikes and lows, and these would happen in a short span of time. You can see it in a slightly longer span, and when it is expanded over multiple years, you see how the chart builds up for the returns that you get when you invest in a equity market. Similarly, if you build a chart for the interest rate that you earn when you invest in the debt market or invest in a debt product, the chart looks slightly different. Unlike the spikes that you see in an equity market, for the interest rates, the chart is a more smoother chart, a more curvy chart, where you see the interest rates go up over a period of time and then they come down and they again start going up over the period of time. So interest rates are a little more predictable in terms of where they move, and the reason is because they are controlled by the Reserve Bank of India or by the central bank of each country, and the policies of these banks, they cannot change every day and they are more predictable, so that they are able to offer a stable environment for the borrowers in the country to understand what is the kind of interest costs they must expect if they were to borrow money in the market. And for you as an investor, you have a little more predictability when putting money in a debt product or in the debt part of your portfolio. Now, when you look at this curve, obviously anybody would love to park all his money when you're at the top of the curve. But this top of the curve is not achieved overnight, and it is possible that we are at the trough of the curve for a long period of time, many months, and then eventually go up and reach the top of the curve. So you cannot be sitting on the sidelines waiting for reaching the top of the curve, and that is when you invest all your money so that you are able to capture the highest interest rate. So how do you think you should be investing your money? Well, a simple way to do that is to ladder your investment portfolio. That is, whatever money you have as a part of your debt portfolio, you want to ladder it out over the tenure for which you should be or you want to be invested. Let me give you a simple example. If you have a portfolio of 25 lakhs and you want to invest it over a 5-year period, what you can do is you can break this portfolio into 5 parts of 5 lakhs each and invest them such that every investment matures at the end of 1, 2, 3, 4 and 5 years. Now, what will happen as a result of this is, you as an investor need not worry about where the interest rates are going to be 2 years down the line or 4 years down the line, and be worried whether you were able to capture the top of the rate or you were at the low end of the rate. By laddering out the portfolio, if interest rates start going up, then you know that every year you're going to have part of your portfolio which is maturing, and that portfolio which matures can be reinvested back at the higher interest rates because the interest rates are going up. And if you're on the other side of the curve where interest rates have started falling, then what happens is every year the maturities that you get will land up getting reinvested at a lower rate because interest rates are falling. But the good part is that a good chunk of your portfolio is already invested at the higher interest rates and you're able to enjoy those higher rates. As a result of this, when you ladder out this portfolio over the 5-year period, you're able to make the best of both a falling interest rate environment as well as a rising interest rate environment. Now, this tenure can be 5 years, it can be 7 years, or it can be 10 or even more. So depending on that, you can ladder out the portfolio with maturities in, say, every year for the next 10 years. You can ladder it out for maybe alternate years, 1, 3, 5, 7, 9. You can ladder it out for up to 15 years, up to 20 years. right? It is entirely up to what is the period for which your portfolio is and how long do you need to manage your debt portfolio for. While it's very easy to find instruments which are maturing in 3, 4, 5 years, right? Today, with RBI giving access to the retail investor to invest in government securities, it has become much simpler to be able to invest in securities which are maturing after 10 years also, and that gives you a advantage to build a long-term portfolio as well when you're talking about your debt part of the portfolio. So if you're a passive investor, the best way to manage the debt part of your portfolio is to ladder out those investments over the tenure so that you're not worrying about how to predict or worrying about where the interest rates are headed, and you have a very evened out portfolio. If a neighbor or friend has asked you whether this is the right time to put money in a long-term debt investment, maybe you should share this video with him so that he need not worry about where interest rates are headed and manage a passive portfolio like the professionals do it.